Hey, good afternoon, everyone. Marty Mazzora here, Tuesday, December 15th, 2020. In this morning's note, I mentioned that the technicals look heavy to us right here. And it's been a while since we've taken a look together at the technicals, so I thought I'd spend a few minutes. I'm going to try to work quickly. I'm going to have you look at the S&P 500 daily chart, which is what we have in front of us. We're going to talk a little bit about some of the supporting indicators that have me suggesting that things are toppy. And I want to look at the VIX with you, and then I want to run through just really quickly a little bit on currencies and then on the individual positions that we have. Sounds like a lot, but I'm going to do it fast. So this is the S&P 500, again, daily chart. You can see where I'm drawing these upward sloping wedge patterns, which are bearish patterns, particularly when we have confirmation that the market is looking heavy, potentially going to roll over. None of this has to come to pass. There can be other exogenous, circumstances, headlines, stimulus programs, sort of thing that come to positive fruition, and that could push the market, change the technicals and everything else. This is just how the market looks right now. So the bars down here, those are the daily volume bars. Obviously, when it's higher, there's more volume, more shares trading hands. When it's lower, there's less. This is the 10-day moving average of the daily volume. Notice that I've drawn some circles in a rectangle down here. What I'm doing is circling right here when we hit this threshold in terms of low volume, either breach it or rest upon it or come very close. What I've noticed over the years is that when we have this dynamic playing out along with a bearish pattern up here, often it's a signal that the market's getting heavy and could roll over. And so right here before the big one, February, March, notice that as the market was topping, volume was really low. So the logic there is that when the market's ramping up and you have low volume, that suggests that there isn't a lot of conviction in the rally. It's not that a lot of people are rushing in. It's just that you have stubborn sellers that are not, accepting yesterday's price. So it has to be bid up. Low volume just means there's not a lot of bidders, but there's nobody really willing to sell at yesterday's price. And then you can see when the market fell apart, volume ramped up, and that's where the passion was on the downside. Here we are coming down to that line. We're just breaking out below an upward sloping wedge and so on. Today we're having quite the rally, so we could very well move back into that trend line, and that might nullify the signal. So as I sit here today, from a volume perspective and from a pattern trading perspective, reason to be somewhat cautious on our near-term outlook. Okay, so from a momentum standpoint, this one I've been showing you for years, the MACD, moving average convergence divergence. This is, by definition, this is a bearish divergence. So we have the market going higher, right in here, a nice uptrend, but we've got a downward sloping MACD. The longer those divergences build, often the longer and the harder the fall. Notice this long bearish divergence as the market was melting up here, and that's what we had there. Here we had shorter term ones, we had a nice sell-off, but it's just continuing at this point. The RSI, Relative Strength Index, another momentum indicator, very clear bearish divergence. The term I like to use is heaviness. This market right here, this rally looks a little long in the tooth, a good catalyst, and of course we could see lower levels. Now we're going to be talking about support down in here and at lower levels. So we'll see how it plays out. No predictions right here, just talking about the technical setup. I mentioned we wanted to look at the VIX. So this is the VIX curve. This is the way I illustrate it for my own purposes. The green is the spot VIX. That's the pricing of implied volatility inside of options for the S&P 500 index. And so I actually, each morning in the morning note, I tell you what the VIX is doing. And these are the futures going out 8 months. So this would be the spot VIX, 1 month, 2 month, 3 months, and so forth. So a steep curve would be where the current VIX is low, right? And as we go out, it slopes. So if you look here, the current VIX is at 22. You go out 8 months and it's at 26, and it pretty much slopes higher or moves higher the whole way. So what this is, folks, is the options market pricing in more volatility as we get into next year. And that's, that's safe to do because you don't know the future, of course. The further out you go, the more chance there is. But what I've noticed over the years is that when I get these wide gaps, when I get this space in here, right, between the spot VIX, where we are right now, and when you go out 2+ months. And that's basically telling you that the market is discounting more and more volatility as we move forward, not so much right now. So that's just kind of a look into the future from a risk standpoint. Now, when the VIX tends to spike up, like it does here, and move into these upper levels, and actually you get an inverted curve when it really takes off, that's when you really have to start wondering what's going on. A lot of times the spike will coincide with a sell-off in stocks. Where you really need to start paying attention is when the market keeps going higher for several days while the VIX begins to go higher. So it wasn't too many, but no, 3-4 days, the VIX peaked up in here, which was kind of a signal that maybe something bad was coming. You can see it right in here in a big way. So you see the VIX for several days rising up here into that September 2nd sell-off. And the market just kept rising up with the VIX. So while folks were rushing in, a lot of new hungry investors who think stocks always go up, it's reminiscent of times I've experienced in the past. Doesn't mean it's going to play out the same. But right now, there's some real bubble characteristics in terms of sentiment in the market. But here we had the market going up on each one of these as a daily bar. And you can see the VIX going up until finally the market cracked. And then here we have the market coming down in October, had a pretty good correction there. The VIX was starting to rise. You go right in here. Again, same thing. VIX was rising while the market was rising. And then here we are right now, folks. VIX is taking a nice spike higher, come down today noticeably. And the market was rising along with it too. So again, nothing conclusive, no big sell signal. Got to have a breakdown right below the trend line before you can say there's a sell signal if you're trading it. But if you're just looking at, like I mentioned in this morning's note, looking for an opportunity to maybe lower your cash allocation, if I believe it makes sense, or if we believe it makes sense longer term, or with new money that's come in, you're looking for a better entry point than what we're seeing right now. A lot of the indicators that we track are beginning to tell us that maybe a better entry point is in the not too distant future, notwithstanding the good seasonality that typically is December. And I want to just talk about currency. So first of all, the dollar. The dollar has been in quite the sell-off mode. In fact, that's what we came into the year, with a weak dollar outlook, going into next year, longer term with a weak dollar outlook. However, right now, technically, the dollar looks like it's going to bottom to me. So you have the opposite. I keep pointing these upward sloping wedges. Well, a downward sloping wedge is actually a bullish pattern, particularly when we have bullish divergences in here. So you can see the market right here, or the dollar, right, is just kind of, it's got a bottom here, and it's got a bottom right in here, a little bit lower. We have a MACD that is bottoming, about to turn into a buy signal when the white line goes above the red. And here's the RSI. For the same line here, we actually have an upward sloping line, and that would be a bullish divergence. So these are technical signs that the dollar may be about to bottom. One way to confirm that is to see what the euro is doing, because the euro is the biggest counterweight in that dollar index. So here's the euro actually looking bearish, right? We have your upward sloping wedge here, and you've got these divergences building, long divergences as well. So this suggests that the euro may be in for quite the sell-off, and that the market's kind of gearing up for that. That would correspond with an increase or a rally in the dollar. Why is that important relative to the stock market? Well, because a strong dollar, particularly in this environment, will probably play serious havoc with stocks. Again, when I line up currencies along with the heaviness in the stock market, along with what I'm seeing in the VIX, and I'll show you some other things in a second, the market looks a bit suspect to me on a immediate to short term, maybe basis. Regular readers and clients know I've got some huge concerns on a longer term basis that may take longer to play out, because the powers that be are doing a really good job of artificially keeping everything very buoyant right here. To understand why we continue to hedge portfolios against that downside risk. In our latest rotations, more to energy, more to cyclical stuff, more to international stuff, we are catching much of the updates on most of them. And on most of the down days, less of the down days, particularly the last few weeks. Even with our hedging, even with the commodities, even with our 18% cash and very short-term bonds, we're able to capture, the lion's share of the market. On some days, we're actually capturing more because of the commodities exposure. Some days, we're going to capture less. Clients, your portfolio is not 100% allocated to stocks like it would be, in a bull market like we largely were from the bottom in '09 all the way up to late summer 2019. That is not the way to responsibly manage money in the environment that we're in right now. Okay, last, I'm just going to scroll through this. I'm not going to work each chart for you. This is my weekly work, and I to the spreadsheet, I copy and paste the daily chart, but we also do a weekly and monthly analysis for every single position that we have. And so, these are, the trend lines and things that we work through. I just wanted to point out that a 2 asterisk means a lower rating from the previous week. This is my own subjective trend score, 1 to 10, or I could say my technical score. So 1 would be the worst, 10 would be the best. And, a couple of weeks ago, I said the technicals were improving. Well, right now, they look heavy to me. So financials, my point is, they're a 6, which is still a decent score, but some deterioration week over week. Banks, a 6, same thing. Tech, a 5. Tech breaking down here below the upward trend line, and then some big long-term divergences here. So tech looks pretty suspect to me right here. Industrials, same kind of look as tech, not quite as big a breakdown just yet. Materials, sideways move out of the wedge, some breakdown here, long-term divergences. Healthcare still gets a 7, same as it was the week before. Staples, same as the week before. Utilities breaking down, although utilities have had a good couple of days, but utilities, we're already sloping down. You notice we've cut utilities 2 or 3 times over the last several weeks, but yeah, not looking good technically. Energy looking good technically, and of course we added to energy, so that's been a big thing. We're more than twice what we were here at the bottom, and we just added it right in this move here. So energy still looks good to me. It actually looked better week over week. So this is more your energy producers. These are your energy service companies, same score. Eurozone equities down a notch to a 6. Asia Pacific down a notch to a 7. Emerging markets still looking decent with an 8. Gold coming back a bit. Gold got all the way down to a 2 or a 3. This is a buy signal right in here. We'll see if gold can break back up and resume an upward trend. Silver gets a 6 with an asterisk breaking above the downward slope of this descending triangle. So we'll see how that plays out, but pretty good look down here, or developing good luck. Ag, keeping it a 7 for now. We'll see if it holds up with this trend line. Base metals, breaking down a bit here, but good enough to keep it at an 8 for the moment, but it's on the verge. The yen stays at a 5, kind of a neutral look. Verizon, down a notch to 2 asterisk. Verizon trying like crazy to break through these highs. Pretty good look here in the moving averages. Somewhat concerning here in these divergences. AT&T gets an 8. Nice move, nice upward slope, nice buy signal in here. Everything looks pretty solid. With the other things that we have our eye on, I would like to move a little bit more into discretionary going into the year if it makes sense. A lot of macro things that we're paying attention to. Doesn't look so good technically. Transportation stocks, that's actually, you can't really see it that well here, but that's a pretty severe move in terms of that big blue candle, which is a down day. So that looks like an impulsive breakdown. So we'll see how transportation holds up. That would be pretty ominous for what it says about the economy. Communication stocks, doing okay. REITs, not looking good at all. So again, nothing that says the world's going to come to an end tomorrow. I have my huge concerns in terms of the solvency risk I'm going to continue to write about. But right now, I wanted to, again, show you just a quick look at the technicals. Yeah, there's much more to it, but I'd be here all day with you. Remember, this is a long-term process. Those big downward moves take out years and years of gains. So we want to be very, very careful when the macro setup says that if sentiment shifts and we get a big downward wave against, there's really underneath all the artificial pumping, a very weak economic outlook. That said, we can't basically sit with our heads in the sand and not understand that a tremendous amount of stimulus is going to be flowing into this market. And the Fed is going to be there to monetize everything the federal government does. We've got to take advantage of those opportunities when they're there, but we have to be thoughtful in terms of entry points. And that's what today's message is all about. Thank you, as always, for watching and listening. You're going to probably notice that the blogs are going to be a little bit a little bit shorter, maybe fewer, for the next week or two as I really dig in and give you something very thoughtful and very pertinent and meaty in the in our end of year message. Thanks again. Take care.